Moving averages, RSI, MACD, Bollinger Bands. Open any trading chart and you'll find dozens of indicators fighting for your attention. In the next 10 minutes, we'll cut through the noise. You'll learn what indicators actually are, the 4 families they all belong to, and the 10 most used indicators in the world, how each one is built, how to read it in seconds, and when it lies to you. Then, how to combine them without cluttering your chart, and the mistakes that trap almost every beginner. Let's decode the chart. First, what is an indicator? It's just math applied to price and volume and drawn on your chart. Every indicator compresses market history into one visual signal. They come in 2 flavors. Lagging indicators, like moving averages, confirm what's already happening. They're late but reliable. Leading indicators, like oscillators, try to anticipate turns. They're early but wrong more often. Neither is a crystal ball. Indicators deal in probabilities, not certainties. They tilt the odds, and that's all you should ever ask of them. Every indicator on Earth belongs to one of 4 families. Trend indicators answer, which way is the market going? Momentum indicators answer, how strong is the move? Volatility indicators answer, how wild is the ride? And volume indicators answer, who's actually committed to this move. Here's the secret most beginners miss. A good toolkit takes 1 indicator from each family. 5 trend indicators tell you the same thing 5 times. 4 families, 4 answers. That's a complete picture. The simple moving average, the oldest tool in the book. Take the last 50 closes, average them, plot the result, and repeat for every candle. The line smooths out the noise so the trend becomes visible. The 50 and 200 period averages are the famous ones, watched by millions. Price holding above a rising average, healthy uptrend. And here's the pro detail. The slope of the line matters more than where price sits. A rising average is a trend. A flat one is a warning. The exponential moving average is the SMA's faster sibling. It weights recent prices more heavily, so it hugs the price action and turns more quickly. That speed powers the most famous signal in trading, the crossover. When a fast average crosses above a slow one, momentum has shifted bullish. The 50 crossing above the 200 is the golden cross, crossing below, the death cross. One warning, in sideways markets, crossovers whipsaw you to death. Trend tools need a trending market. MACD, moving average, convergence, divergence, the king of trend momentum indicators. It measures the distance between 2 EMAs, that's the MACD line, then smooths it into a signal line and plots their difference as a histogram. Read it in 3 ways. MACD above the signal line, bullish pressure. The histogram growing, momentum accelerating. And the 0 line crossover marks a genuine trend change. 1 indicator, 3 readings, trend, momentum. In turning points, that's why it's on every platform on Earth. The Relative Strength Index, RSI, the world's favorite momentum oscillator. It scores the market from 0 to 100 based on recent gains versus losses. Above 70, overbought, below 30, oversold. But here's what beginners get wrong. Overbought does not mean sell. In a strong trend, RSI can stay pinned above 70 for weeks while price keeps climbing. Use the 50 line as your trend filter. Above 50, bulls control, below, bears do. Extremes are warnings, not triggers. Now the most powerful oscillator signal of all, divergence. Price makes a new high, but the RSI makes a lower high. The engine is weakening while the car still rolls forward. That disagreement between price and momentum often marks exhaustion before the turn. Bullish divergence is the mirror. Price grinds to a new low, but momentum quietly rises. Divergence works best at major support or resistance, and it's an early warning, not an entry by itself. Wait for price to confirm. Stochastic oscillator asks one question: where did we close relative to the recent range? Closing near the highs of the range scores high, near the lows scores low. 2 lines, %K, fast, and %D, it's smoothed signal. Above 80 is overbought territory, below 20, oversold, and the classic trigger is the K line crossing D inside those extreme zones. The stochastic shines in sideways, range-bound markets and gets dangerous in strong trends, where it stays pinned, just like the RSI. Bollinger Bands wrap price in an envelope, a 20-period average in the middle, with bands 2 standard deviations above and below. That means the bands breathe with volatility, expanding in wild markets, contracting in calm ones. The tightest contraction, the squeeze, is the market coiling before a big move. In a strong trend, price can walk along the upper band for days. That's strength, not a sell signal. And touching a band alone is never a trade, it's context, not a trigger. The average true range, a TR, is the most underrated indicator on this list. It measures one thing, the size of a typical candle, pure volatility, no direction at all. So what's it for? Stops and sizing. Place your stop loss 1.5 to 2 TRS away, and normal market noise won't shake you out. Divide your risk budget by the ATR, and every position carries equal risk. Calm stocks get bigger size, wild ones get smaller. Professionals size everything with it. Volume, the only indicator that isn't derived from price, it's its own raw data, how many shares or contracts actually traded. Volume is the lie detector of the chart. A breakout on heavy volume, real, backed by committed money. A rally on fading volume, suspicious, running on fumes. And a massive volume spike after a long move often marks the climax, the final burst before exhaustion. Price tells you what happened. Volume tells you how much to believe it. Unbalanced volume, OBV, turns volume into a single running line. Up day, add the volume, down day, subtract it. The line's direction reveals accumulation or distribution. Is big money quietly buying or quietly leaving? Rising OBV under a rising price healthy? But when price pushes to new highs and OBV refuses to follow, the buying power behind the move is thinning. That's volume divergence, and it has called major tops. Simple math, serious signal. VWAP, the volume-weighted average price, the institutional benchmark. It's the true average price of the day, weighted by how much traded at each level, and it resets every morning. Big funds judge their fills against it, which makes it a magnet and a battleground. Price above VWAP, buyers control the day, below it, sellers do. Pullbacks to VWAP in a trending session are the classic intraday entry. If you day trade and use only one indicator, this is the one. Fibonacci retracements map where pullbacks tend to end. Stretch the tool from a swing low to a swing high, and it draws levels at 38, 50, and 61.8% of that move. Healthy trends typically retrace into that zone and then resume. Why does it work? Partly market rhythm, partly because millions of traders watch the exact same levels. It's self-fulfilling. The real power comes from confluence, a Fibonacci level sitting right on old support, watched by everyone. Now, how to combine indicators without wrecking your chart. The rule, one per family, never two of the same. 5 momentum oscillators is one opinion shouted 5 times. A clean stack looks like this: an EMA for the trend filter, RSI for timing the entry, a TR for the stop, and volume for confirmation. Trend, momentum, volatility, volume, 4 families, 4 independent answers. 2 or 3 visible indicators maximum. If your chart looks like abstract art, you're not analyzing, you're hiding. Here's the whole playbook as one repeatable workflow. Step 1, read the trend with your moving average, only trade in its direction. Step 2, wait for the pullback into value, a Fibonacci zone or the middle band. Step 3, time the trigger, RSI turning back up or a stochastic cross. Step 4, set the stop at 1.5 a TRS beyond the noise. Step 5, check volume for confirmation. 5 steps, 1 decision at each. That's a system, not a guess. 4 indicator mistakes that trap nearly everyone. Indicator overload, 10 tools, total paralysis, and they mostly repeat each other. Worshipping default settings, 14 isn't magic, it's just the default. Understand the tool instead of cargo culting numbers. Ignoring price itself, indicators are derived from price, candles and levels always get the final vote. And treating overbought as an automatic short. Strong trends stay overbought longer than your account stays solvent. Respect the tool's limits, and it will serve you. Your cheat sheet by family. Trend, the SMA, EMA, and MACD, they tell you the direction and its health. Momentum, RSI, and Stochastic, they time your entries inside that trend. Volatility, Bollinger Bands, and a TR, they size the playing field and your risk. Volume, raw volume, OBV, and VWAP, they tell you whether to believe the move. Screenshot this. Pick one from each row, learn it deeply, and you're better equipped than most traders ever get. Let's recap. Indicators are math on price and volume, probabilities never promises. 4 families, trend, momentum, volatility, and volume. Build your toolkit with one from each. You now know the Big 10, moving averages, MACD, RSI, Stochastic, Bollinger Bands, a TR, volume, OBV, VWAP, and Fibonacci, plus Divergence, the signal that spots weakness early. Keep the chart clean, follow the 5-step workflow, and let price make the final call. If this helped you, subscribe to this channel for more clear, visual market explainers, and I'll see you in the next one.